All right, let's talk about one of the most powerful decisions in all of finance. It's this single choice. Do we capitalize a cost or do we expense it? Now I know it sounds super technical, but trust me, this one judgment call can build fortunes, it can supercharge valuations, or it can bring a whole company crashing down.
So let me ask you this. How is it possible for two companies, totally identical, to both spend the exact same amount of cash, say $1 million, but at the end of the year, one reports a huge profit and the other reports a massive loss? It seems impossible, right? They spent the same money. Well, the answer isn't some kind of financial wizardry. It's accounting.
And that really gets to the heart of it. This choice, capitalize or expense, it's not just about crunching numbers or following rules. It's about telling a story. When it's used with integrity, it gives us a true and fair picture of a company's long-term health. But when it's abused, well, it becomes a veil, a perfect way to hide some really deep problems. So here's our game plan. We're going to start with the basics. What is this choice? Then we'll look at the ripple effect it has across the financial statements. After that, we'll get into the fun stuff, how to spot the red flags of manipulation. We'll even look at a real-world battleground for this, R&D spending. And finally, we'll talk about how you can read between the lines.
Okay, first things first, asset or expense. Let's get the core concepts down cold.
Let's start with expense. An expense is pretty straightforward. Think of it as a short-term cost. You pay for something and you get the benefit pretty much right away, and that benefit is used up within the year. So the cost hits your income statement immediately, which of course lowers your profit for that period. Simple as that.
Now, on the flip side, we have capitalize. This is for your long-term investments. If you spend money on something that's going to keep providing value for more than 1 year, you don't hit your profits with the whole cost at once. Instead, you record it as an asset on the balance sheet, and you spread that cost out over its useful life. And here's a perfect, simple way to think about it. Your daily cup of coffee, that's an expense. You drink it, you get the benefit, and poof, it's gone. But what about the fancy espresso machine that made the coffee? The one that's going to last for 5 years? That's an asset. You capitalize it. Why? Because its value sticks around for a long, long time.
So what's the big idea behind all this? Well, it all comes down to what accountants call the matching principle. You can think of it as the North Star for this whole decision. The goal is to match your costs to the revenues they help you earn. You spread the cost of that espresso machine over 5 years to match the cost with all the revenue you'll generate from selling coffee for those 5 years. It just makes sense.
Okay, now that we've got the concept down, let's look at the financial ripple effect. This is where you really start to see how this one little choice can change absolutely everything.
First up, the income statement. When you capitalize a cost, you're basically kicking the full impact down the road. So instead of taking a big hit to your profits in year 1, you only recognize a tiny piece of it called depreciation. The immediate result? Your profits look way higher up front, and your earnings stream looks much smoother and more predictable over time.
And what about the balance sheet? Well, instead of that cash just vanishing as an expense, it gets transformed into an asset. This instantly makes your total assets number go up, which also boosts your shareholders' equity. On paper, the company just looks bigger, stronger, and a whole lot more valuable.
Now this next one is a little sneaky, but it is so important. On the cash flow statement, an expense shows up as cash used in operations, but a capitalized cost, that gets moved down to the investing section. This simple reshuffling makes your cash flow from operations, a really key metric for a company's core health, look much, much stronger.
And you can see the domino effect this has on all the key ratios that analysts watch. Capitalizing gives a big boost to EBITDA. That's earnings before interest, taxes, depreciation, and amortization, a really popular metric. It also boosts net income in the early years and, like we said, operating cash flow. But here's the catch. Over the long run, it can actually push down your return on assets since your asset base keeps getting bigger.
So you can see how tempting it is to capitalize things. It makes the numbers look great. But that leads to the big question. How do we know when a company is using this to mislead people? This brings us to the dark side, spotting the red flags of manipulation.
Here are a few telltale signs you should always be on the lookout for. A huge one is when net income is climbing, but cash from operations is flat or even falling. That is a classic sign of paper profits. Also, keep an eye on a declining asset turnover ratio. That could mean all those new assets aren't actually helping to sell more stuff. And you definitely want to be suspicious if a company starts capitalizing routine things, like basic maintenance or marketing.
And if you want a case study in just how bad this can get, look no further than the infamous WorldCom scandal.
It all started with this number, $3.8 billion.
So what did they do? It was shockingly simple. They took their biggest operating expense, the fees they paid to use other companies' phone lines, and just relabeled it. They pretended it was a long-term capital investment. With a few key strokes, they turned what was actually a massive loss into a reported profit of over $1 billion. Pure fraud.
This whole issue creates a really fascinating dilemma for analysts today, especially when it comes to research and development. It's a real battleground.
So check this out. In the US, under rules called GAAP, companies have to expense pretty much all of their R&D spending right away. But under the international rules, called IFRS, it's different. Once a project hits certain milestones and is likely to be a commercial success, companies have to start capitalizing those development costs. This creates a huge headache for investors trying to compare, say, a US tech firm with a European one.
So how do the pros get around this? Well, many of them use a technique made famous by Valuation Guru, as with Damodaran. They basically rebuild the financial statements themselves. They'll estimate a useful life for the R&D, say 5 years. Then they go back and treat all that past R&D spending as if it were an asset, and then they adjust the company's operating income. It's a way to create a truer picture of a company's real investment and profitability.
And that brings us to the finish line, reading between the lines. This is about taking all this knowledge and using it to get a totally new perspective on the numbers.
I think this quote just says it all. This accounting choice has two faces. Used properly, it helps us see a company's long-term vision. But when it's abused, it becomes nothing more than a tool to hide the truth, to cover up failures and a lack of real cash.
Look, at the end of the day, getting a handle on capitalizing versus expensing isn't just some boring accounting rule. It's a fundamental upgrade to your ability to analyze a business. It takes you from being a passenger, just accepting whatever numbers the company gives you, to being the captain, steering your own analysis with real insight.
Because that's what this is all about, right? The numbers on the page aren't just numbers. They're telling a story about the company's strategy, its true health, and maybe even its integrity. The only question is, are you ready to read it?